Hi everyone, this is Mehul Mehta. We are recording this series on value at risk, in which I'll be walking you with the concepts that is, what is value at risk, what are the key elements of value at risk, how to calculate value at risk using three methods that is, variance covariance method, historical method, and Monte Carlo simulation method. Then we'll be covering why should we study value at risk, in which asset classes do we use the concept of value at risk, some of the disadvantages of value at risk. Also, I'll be covering everything in Excel so that it's easy to follow. So we'll be building a value at risk model using the variance covariance method, historical method, and the Monte Carlo method in the Excel. But before diving deep, let me give you a quick introduction. My name is Mehul Mehta. I did my electronics engineering back in India from VIT University, Vellore. After my undergraduate, I joined PwC in their risk and regulatory department. Worked for almost close to 3 years, built couple of credit risk and market risk models. After that, I came here to United States to pursue my master's in financial mathematics. The program was of 18 months. And then after graduation, I joined a commercial bank in Alabama. Worked there for 18 months, built a lot of quantitative models. And after that, right now I'm working as a manager in risk modeling department. So that's my overview. Now let's start the topic. Value at risk. So what is value at risk? Value at risk is nothing but it tells, right? It tells like what is the extent of possible financial loss within a firm, portfolio, or position over a specific time frame at a specific confidence interval. So this matrix, if you see, is commonly used by investments, commercial banks to determine, the extent of potential loss in their institutional portfolio. So let's start. Value at risk. So even though we write value at risk, but it can be also written as V small a and R, okay, capital R. So value at risk is the extent of financial loss within a portfolio or position. Let's say if we have taken certain positions in the market, so over a specific time frame at a specific confidence interval. This is, the like definition is what is value at risk. So mostly it's used in financial risk management to estimate the amount of potential loss that could be experienced under normal market condition in a set period of time. So essentially, value at risk answers the question, what is the potential loss over a certain period at a certain confidence interval? Okay. So value at risk, essentially value at risk answers answers the question, what is my potential loss over a certain period of time at a certain confidence interval? So this is what value at risk is trying to answer. Okay. So now let's understand what are the key elements of value at risk. So the key elements of value at risk are only two components. Okay. So there are two components, or let's say there are two primary components of value at risk. Okay. That are first time period and second is confidence interval. So let's cover time period. Okay. So time period is nothing but it's the duration over which the risk assessment is made. See, value at risk because it tells the extent of potential financial loss. That's why it's a risk assessment measure. So time period is important because it tells, the duration over which the risk assessment is made. Now this time period could be a day, a week, a month, or any other time frame depending on the use case. So time period is the duration over which risk assessment is made. Now, this risk assessment, the time period could be a day, it could be a week, a month, or any other time frame depending on the use case. Okay. So this is the first element of value at risk. Second element, which is confidence interval. Okay, before going deep into confidence interval, let me take certain example. So how we say, okay, is 1 day value at risk. So what does this mean? 1 day value at risk, right? Let's take this example, 1 day value at risk. So what it means is we are trying to calculate the potential loss in our portfolio over a period of 1 day. So what does this mean is we are trying to calculate the potential loss in our portfolio over a period of 1 day. And similarly, let's say if we have a 10-day VAR, okay, what does this mean? This basically means that we are trying to calculate where, or let's say we are trying to calculate the potential loss in our asset over a period of 10 days. So we are trying to calculate potential loss in our portfolio over a period of 10 days. Okay. So let's move on to the second element. So I hope you understand what is the first element, which is the time period. Let's take the second element, which is the confidence interval. As we have studied this confidence interval back in your statistics class, so it's basically a probability measure that indicates the certainty level with which the results can be expected. So this is the probability measure that indicates the certainty level with which the results can be expected. Now, common confidence interval that we consider in value at risk are, let's say, common confidence interval that we calculate that we consider in value at risk are 99%, 95%. So these are, commonly reported. Now, when we combine these two elements, that is when we combine time period, okay, let's say, so when we combine these two elements, okay, which is the time period and the confidence interval, that is the complete reporting of value at risk. This makes the complete reporting of value at risk. So how we will say is 1 day 99% value at risk. Okay, so this is what this means is we are calculating our potential loss over a period of 1 day, and the confidence interval that we are taking is 99%, and where is nothing but we are trying to calculate value at risk. So you might be thinking, okay, how to calculate value at risk, right? How to calculate value at risk. See, as we understand, value at risk is a risk measure which basically tells us how much, basically it tells us the potential loss in our portfolio over a specific time frame and a specific confidence interval. But there are three ways. So basically, there are three ways to calculate value at risk. That is variance covariance method. Then we have historical method. And the last is Monte Carlo simulation method. So these are the three methods that we use to calculate value at risk. We'll be diving deep into all the into each method and basically building out in this in Excel. But before into diving deep into how to calculate value at risk, I just want to make you understand why should we study value at risk, right? So I want to make you understand why should we study value at risk. Okay. The main reason for studying value at risk, of course, because it's an important matrix. But other than that, it's because of risk management. We need to understand what is value at risk. There are a lot of regulatory compliances which require the reporting of value at risk. Basically, we can do portfolio optimization, performance benchmarking, and stress testing. But let's understand each of this one by one. First, risk management. So basically, if you see value at risk, right, it provides a quantifiable measure of market risk that an investment or let's say a portfolio might face over a specific time. So basically, this helps, the risk managers and the investors to understand the amount of capital that may be lost and to prepare accordingly. So that's why value at risk is important for risk management purposes. So since we know that value at risk provides a quantifiable measure of market risk. So when I say market risk, basically, the potential loss, okay, that an investment, or let's say that a portfolio might face over a specific period of time. So this will help all the risk managers, let's say, because it helps you understand the market risk. Therefore, it will help the investors, or let's say the risk managers, right? How will it help to understand? Basically, it will help them to understand the amount of capital that may be lost, and therefore prepare accordingly. Okay, and therefore prepare accordingly. So this is why, of course, like this is one of the main reason why should we study value at risk. Then moving on, second reason, regulatory compliances. So many financial institutions are required by regulators to calculate value at risk to ensure that they have enough capital reserve to cover the potential losses. This whole process of regulatory reporting helps maintain the stability of the financial system by ensuring that the institutions are not overly exposed to the risk without the adequate capital buffer. So if you see all the big banks, or let's say any financial institution, they are required, all the financial institution are required by regulators to calculate value at risk. Okay, everyone has to do that. Why they have to do that? To ensure that they have enough capital enough capital reserve enough capital reserve to cover the potential losses. So this basically helps, if you see, this basically helps maintain the stability. This helps maintain the stability of the financial system. Okay. Third, portfolio optimization. So portfolio managers, or let's say investors, they use value at risk to assess the risk associated with their portfolio and then to make informed decision about the asset allocation. By understanding the risk, managers can optimize their portfolio to achieve a desired balance between the risk and the return. So in portfolio optimization, how the portfolio managers optimizes? Basically, if you see, portfolio managers use value at risk to assess the the risk associated with their portfolio, and this helps them to make informed decision about the asset allocation. By understanding the risk managers or portfolio managers can optimize their portfolio to achieve a desired to achieve a desired balance between risk and return, between risk and return. Okay. Now, fourth is, see, this I am telling you all this point just for you to understand, okay, why we are studying this. Performance benchmarking. So if you see, value at risk is used to benchmark the performance of portfolio. Basically value at risk is used to benchmark the performance, by comparing the level of risk all the portfolio managers are taking against the returns they are generating. So basically, it serves as a tool to evaluate whether higher returns are achieved through higher risk or through superior investment strategies. But see, again, this point is, basically it covers into it. It is already covering into this. So let's move to our next topic. Okay, but these are, the major reasons why we should study value at risk now. So let's understand in which asset classes value at risk can be used. Okay. So the answer to this question is value at risk can be applied to a wide range of asset classes, making it a versatile tool in risk management across different types of investments. Okay. So some of the common asset classes where value at risk is used are equities, derivatives, fixed income, foreign exchange, commodities, etc. So value at risk can be applied to a wide range of asset classes, making it a versatile tool in risk management across different types of investments. So asset classes, some of the common some of the common asset classes are first equities, derivatives, fixed income, commodities, foreign exchange, or we also say this as forex. So these are, some of the common asset classes in which we use value at risk. So now let's understand, of course, you understand, okay, value at risk, of course, tells us the potential loss in our portfolio. But of course, there are some disadvantages also of using value at risk, because we have already talked about the advantages, such as, it's helpful for risk management, it's helpful for regulatory reporting, or let's say regulatory compliance. It's helpful for portfolio optimization, right? So let's understand some of the disadvantages. So first disadvantages is, as I told you above, that because there are three ways of calculating value at risk, that is um, that is variance covariance method. The second one is historical method, and the third one is Monte Carlo method, right? So each of this method gives a different value at risk number. Okay, so all this, so whatever value at risk that we will get in the end, right? These are not the same. These are all are different numbers. So, it's very hard to understand which one should we consider, right? Which value at risk number should we consider? So this is like the first limitation. Because what generally happens is, for any of the risk measures, if you see, there can be different methods, right? But in the end, you get like the same results, right? So these can be method one, method two, method three, but you should get the same result. But what happens with virus, because there are three different methods, right? So it is giving three different value at risk number. So this is the first limitation, or let's say the first advantage of VAR is, because there are three different models. Okay, there are since there are three different models to calculate VAR, this gives us three different results. Okay, so which result to consider is the question. Mm. So this is the first limitation of value at risk. Like that is three different models, three different results. Second, model risk assumptions. See, when we are trying to calculate VAR, right? So the value at risk calculation relies heavily on the models and the assumption used. So you will see, like, we take certain assumption, like, okay, the stock, or let's say the market return should follow normality, and it has happened that certain assumptions that we have considered, they do not hold true in all the market conditions. And when this happens, right, it often leads to potential inaccuracies. So you need to make sure, like, whatever assumptions you are taking, it should actually match with the market conditions. So that is why when the conditions are not met, a model risk actually occur. So we can say that value at risk calculation relies heavily on the models and the assumptions. So sometimes, right, These assumptions may not hold true in all the market conditions, and this will lead to potential inaccuracies. So this is the first, no, so this is, the second disadvantage of using value at risk. Third, tail risk. So value at risk definitely provides the information of potential loss within a certain confidence interval, but it does not account for the magnitude of loss that could occur beyond this threshold. So this could, underestimate the risk of extreme events, which is also known as the tail risk. So just to simplify, what I mean is, let's say we say, okay, one day 95% value at risk is, let's say, $1 million, right? So what do I mean by this? I mean that I'm 95% confident, okay, that my losses will be less than $1 million. Okay. So I'm 95% confident that my losses will be less than $1 million. But as we know, there's still a 5% chance that my losses can be greater than $1 million. But the question is, how much greater, right? Is it, let's say, $2 million? Is it $10 million? Is it $100 million? $1 billion? This, the magnitude of loss, right? This is not told by value where. So this is one of the limitations also, because okay, we are very confident, okay, that okay, 95 at 95% confidence interval, the losses can be less than $1 million. But in this uncertainty period, right, the 5% period, losses can be more than 1 million, but and the magnitude, it doesn't justify. So it can be anything. So this is this is one of the most biggest limitation of using value at risk. So basically, value at risk provides information on potential losses within a certain confidence interval, let's say 95% or 99%, right? But it does not account for the magnitude of losses that could occur beyond this threshold. We all know that when we take 95% confidence interval, so if this is we are certain with this confidence interval, uncertainty will be 5%, because at the end of the day, the total should be 100%, right? So if we are 95% confident, it means 5% I'm not confident. So it does not tell how much, how big, how, like, what's the magnitude of loss that could occur in this threshold. Similarly, if we have, let's say, 99% confidence interval, then this is like the threshold, which is like this becomes the threshold that is after the 99%, that is in this 1%, we do not know what will be the losses, and again this also makes up to 100%. So these were certain limitations of using value at risk, but let's now deep dive of just to understand how to calculate value at risk using different methods, that is variance covariance method, historical method, and Monte Carlo method.